Understanding the $15 price target. This research is not intended to be FUD, which is fear, uncertainty, or doubt, but I imagine you will have one of three emotions by the end. You will be fearful that I'm right, anger that I can even think like this, or doubt that there is anything here that is valid. I want to disclose up front I do not plan to sell, but I want you to have an overarching reasoning behind why things could potentially go wrong for us. I began listening to The Psychology of Money since I am merely a high school band and chorus teacher and not some savant that knows the ins and outs of the market. At 29 and on a $35,000 salary, I have invested about $100,000 into stocks. I've been lucky, but I also have some time since I started investing, since I started around 21 or 22. In the book Psychology of Money, there are tons of key takeaways, but I want to pretty much only go over luck and risk. Luck and risk is something we all have with Palantir. We are lucky to be able to own a piece of a company that checks all of my boxes. Do they have a good CEO? Check. Strong founders? Check. Probably growing a ton in the next few years? Check. Strong top line growth? Check. I will remind you, though, that owning any company comes with risk, even Palantir. Right now, my belief is that the risk is not the company of Palantir, but the stock price, or the PS, which is the price to sales ratio. So, what is wrong with the PS? Only a few short weeks ago, when we were at 25, and I was looking to get in around 22 and started my bullish thesis, I posted here before. I compared everything to top line growth almost solely because we have yet to have profitable net income. I thought any sales multiple under 30 sounded insane because of how strong the company and the growth of the company has and is. Here is where things have taken a turn for me. The negative sentiment in this subreddit, alongside with rapidly declining share price, I needed to even further my conviction about my price targets and my estimates. I needed to know, why did any analyst list them for $15? Understanding the $15. I know there are many variables that could send someone to this price target. I mean, many variables, but I don't know what, if any, of them are right. If you need to mix them all, a few, or if nobody understands anything. I, however, stick with my good old top line growth, which is revenue, and the market cap. So I got to work comparing a bunch of companies' revenue to market cap. Here, you can see a couple of companies in chart form. Feel free to look at them. You can see Snow is being crazy with its revenue and market cap. C3 and Palantir ranks third out of the ones that I found and used as my baseline comparison. You can just see the total numbers right here, and we will move on. So going through the revenue numbers here very quickly. In 2012, Now had 244 million gross. In 2013, they had a 74% increase up to 425. 2014, a 60% increase up to 683. In 2015, they were up to 1 billion. In 2016, they had another 38% increase to 1.39 billion. 2017, 1.9 billion, another 37% increase, then another 36% increase, then another 32% increase, and finally a 30% increase into 2020, getting us up to that $4.5 billion range. Now, here is why I liked looking at them the most. First off, we can then compare what a growth company doing about 30% will grow at and what the price to sales for Palantir could potentially be if we also grow at a rate very similar to this, as per the guidance by Alex Karp. ServiceNow Incorporated is the closest company I've found to a Palantir looking at the top line numbers alone. Earning over 30% in the last 5 years, this falls in line with Palantir's guidance with having a top line of over 30% for the next 5 years. Things to note: I took a best guess at the stock price looking at the chart and picking a guessed average for a month around February or March, which is when I presumed they would have been posting earnings for the year. I did look up what shares outstanding was for each year to get to the market cap for now. Key takeaways. The key takeaways is ServiceNow trades at a price to sales ratio of 25. The average of the last 4 years is 18, and altogether, excluding 2015 through 2020, they averaged 23.1. They were not profitable until 2019 when they posted a rather substantial profit. 2020 saw some profits, but still a continued strong growth in the company. This company is fundamentally 2 times Palantir in market cap, but 4 times in size and revenue. ServiceNow is a software company like Palantir. ServiceNow has a PE ratio, or price to earnings ratio, of over 625. It was 644 as of April 7th. I do not wish to compare ServiceNow to Palantir on anything but top-line growth alone, but I do wish to share share dilution as well. The share dilution for 2012 into 2013 was 74 million to 135 million shares outstanding, a very sizable increase. Their shares outstanding from 2013 to 2014 was 135 to 145, so only a 10 million share increase this time. And their shares outstanding for 2017 to 2020 are as follows. They went from 172 to 178 to 197 to 220, meaning their percent of shares outstanding went up 3.5%, 10.6%, and then 11.7%. So quite a lot of share dilution throughout the entirety of the company. I think it's just very interesting to kind of use that as a key takeaway. That many shares going out, but still that strong of a price to sales ratio might be something similar we see to Palantir. Palantir might do less than that in terms of share dilution, but we will find out over time. Of course, they could do more, but I also think Palantir can do more than this 38% 5-year average growth rate percent. But we'll see. That is getting into speculation. Getting into our next company with Tesla. Looking at Tesla's numbers starting from 2010, they had a revenue of 117 million. 2011, they went up 74% to 204, moving 102% in 2012 to 413, 387% to 2013 and 2013, 58.5% to 3,198, then 26.5% up, then 73% up, then 68% up, 82.5%, 14.5%, and finally into 2020, they went up 28.31%. During that entire time, they had a price to sales ratio starting in 2010 of 6.83, then 11.8, then 8.97, then 2.22, then 7.79, then 6.33, 4.22, 3.52, 2.58, 2.12, and finally 4.46 in 2020. We can also look at the share dilution Tesla has had. From 2010 into 2011, their share dilution went up 97.64%. Then it went up nearly 7%, then 11%, then 4%, then nearly 3%, then 12.5%, then 15%, then almost 3% again, then 4%, and finally 22% share dilution in 2020. Here are my key takeaways for Tesla. Tesla trades at a 21.4 price per sales as of Friday, 5/7/2021. Tesla trades at an EPS, or earnings per share, of over 650. That would be 668.7 at the time of writing. In 2020, Tesla had their first net income. Tesla is not a software company, making them very different from Palantir. Tesla has a strong branding with Musk as their CEO. Due to the above and more, Tesla has a strong following and loyal customers. Let's look at the share dilution for Tesla for the last 4 years. Tesla has a rather large share dilution amount of 15%, nearly 3%, 4%, and then 22%. They have a historic price per sales, that seems incredibly low to me. For both examples, I used a lot of data from macrotrends.net. Looking at these companies and others to make your own guesses would be very advisable. Bringing this back to Palantir, the average PS for software companies is 24.8, as gleaned from the website equidom.com. If we were to trade at a 24.8 price per revenue or sales, as is industry standard, the market cap should be 27.1 billion. At our current shares out, this means that we would trade at a share price of 14.41. Using this number alone, I can see why an analyst thinks $15 is a fair price target. With how strong of growth Palantir had during its lifetime as a company, I could see how it may trade at a higher price per sales. Given the knowledge of those other companies, I can see why they put a price target with new earnings as low as it is. So, as the company continues to get crushed, look at what happens to people who hold value stocks long term. The company projects 30% growth year over year. If we can presume a price to sales ratio just under the software average, we can realistically have a share price of $34 in 2025. This includes the values seen below. In 2020, our trade ratio is market average at 24.35, giving us a share price of 14.6. If our share dilution is up 10% and we trade at a trade ratio of 24, we have a share price of 18.31 by the end of fiscal year 2021. 2022, our trade ratio decreases down to 23, and our share dilution stays at 10%, giving us a share price of $20.74. 2023, we have a trade ratio of 22 and a share dilution of 8%, giving us a share price of $23.88. 2024, we have a trade ratio of 20 and a share dilution of 7%, giving us a share price of $26.38. And by 2025, if they have continued to trade at a 30% growth year over year, we could have a $34.60 trade share price with a trade ratio of 21 and a share dilution of 4%. I think this is the doomsday scenario that includes very high share dilution, a decreasing multiple over time, and only beating earnings in 2021. I chose 40% followed by 4 consecutive 30% years. So if I think I won't break even for 2 years, why am I holding? This company is poised to grow at an exponential rate. Take a look at what Palantir has done in the past. Their revenue growth over time. Take a quick second to look at the chart so that you can see what that looks like. Palantir has a 30% year-over-year growth rate for the next 5 years leading up to 2025, but they have met or exceeded 30% growth for 8 of the last 12 years they have been a company. I would remind you that most of Palantir's capital came almost exclusively with government contracts. The only thing I'm wary of is that their growth rate did decline into 2017 through 2019, meaning they perhaps were starting to get less lucrative or just less contracts during that time. It may also just be the time they were reorganizing their contracts to not be paid up front, using the capital they had already acquired to build a more consistent revenue. That being said, they had a massive 47% this year, and even with COVID, and so many companies now know that they need software like Palantir's. If the government contracts are still making up a huge growth section and they add company after company in the retail sector, I see no reason for less than 40% growth year over year and a PS of higher than 24.35, especially when they become profitable. Lastly, again, I want to state that the share dilution I put is likely higher than what we will see, meaning the price per share should increase on that front as well. This is my understanding of the $15 price target. This is my understanding why we go down on good days and down on bad days and down on no news. People are afraid of how expensive their stock is, and it was substantially overinflated in January through March. We saw earnings beat and the stock sank, which scares investors. I want to believe in this company, and I do believe in this company, but this stock will continue to scare me for some time because now, after having thrown lots of money at the stock, I think I understand why I should have tried to buy under $20 or even at 15. If you wouldn't mind giving me some advice on things that I could do better, or if there's anything that you think is wrong with this intelligence, please let me know and I will do the best I can to make it better in the next one. Thanks.